Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden within corporate filings. Today we're diving into AA Mission Acquisition Corp. The second's latest report, and let me tell you, this one's a bit of a puzzle. We'll be looking at their financial health, what they're planning, and some interesting moves from their early days. Stick around. And if you like getting the real story behind company reports, make sure you are subscribed. We also have a Discord community linked in the description below, so come hang out. Alright, so we're looking at a Form 10Q report, which is basically a quarterly update for investors, and the public AA Mission Acquisition Corp. AA Mission Acquisition Corp. As we'll call it, is a company that is basically looking for another company to merge with, a sort of special purpose acquisition company or SPAC. They had their initial public offering, or IPO as everyone knows it, back in October of 2025. This report actually covers a very short period from their start in May 2025 up to the 30th of June of that same year. Now, for a company that is basically just getting started and hasn't even found its target yet, the financials are pretty simple, but they show us the initial setup. Let's jump straight to the important numbers in their financial statements. Companies like this, when they first start out, don't have much. Scroll Mission Acquisition Corp. True balance sheet. Scroll as of the 30th of June 2025. Their balance sheet shows very little in terms of assets. We see some prepaid expenses of $55,900 and deferred offering costs of $258,564. On the liability side, they had accrued expenses of $200,707 and due to a related party of $131,350, totaling $332,057 in current liabilities. The shareholders deficit section also tells a story. It lists Class B ordinary shares with about 2.8 million issued, but the big picture here is a total shareholders deficit of nearly $17,600. This isn't unusual for a company in its very early stages, especially when planning an IPO. They've spent money getting ready but haven't brought in revenue from operations yet. Scroll Mission Acquisition Corp. Thurker's statement of operations. Scroll looking at their statement of operations for that partial period, you'll see a net loss of $42,593. This loss comes entirely from general and administrative expenses. No revenue yet, which is expected. They report a basic and diluted net loss per Class B ordinary share of $0.02. This is a number to watch as they grow, to see if their losses per S-hair shrink. Scroll Mission Acquisition Corp. Fee statement of cash flow. Scroll now, let's check the cash flow. For the period from their inception to the 30th of June 2025, their net cash used in operating activities is listed as zero. This seems odd, but it is because the substantial cash from their IPO hadn't really flowed in yet at this specific reporting date. There are some interesting non-cash items here. Notably, $25,000 in founder shares were issued in exchange for deferred offering costs and accrued expenses paid by their sponsor. This hints at how they funded early operations before the IPO cash infusion. Scroll Mission Acquisition Corp. Through notes to financial statements. Scroll, we need to dig into the notes to understand what is really going on. This is where the details that paint the whole picture live. This note tells us the company was formed in May 2025 as a blank check company, meaning its main purpose is to find and merge with another business within a set time frame, usually 18 to 24 months after its IPO. If they don't find a target, they have to wind down and return money to shareholders. The big financing event, the IPO, was declared effective on the 30th of September 2025. They then sold 10 million units at $10 each, bringing in $100 million. They also had a private placement with their sponsor, AA Mission Sponsor 2, selling over 300,000 units for another $3.3 million. It is important to see the cost of this IPO. They spent over $4.6 million on transaction costs. This includes underwriting fees and other expenses. It is a significant chunk of money just to get the company public. Most of the money raised, over $115 million, went into a trust account. This money is earmarked for acquiring a business. Only the funds outside this trust account are available for day-to-day operations. This next part is crucial for understanding the risks. The report mentions that the company's ability to continue as a going concern, meaning stay in business, raises substantial doubt. This is mainly because if they don't find a business to combine with before their deadline, they'll have to liquidate. As of the 30th of June 2025, they literally had no cash and a deficit in working capital. This is before the IPO funds were fully in use. However, after the IPO and the over-allotment option were exercised, their operating account had over $1 million. This highlights the timing of their funding. This section details how they do their accounting. They are an emerging growth company and are taking advantage of certain relaxed rules, like not having to comply with new accounting standards as quickly as larger companies. This can make comparisons tricky, but it is a common strategy for newer companies. They also mention how they'll account for warrants, which are essentially options to buy shares later. For now, there are no warrants outstanding as of the 30th of June 2025, but they will be a key part of their capital structure. This confirms the details of their IPO. So 10 million units at $10 each. Each unit came with a share and half a warrant. The warrants can be exercised at $11.5 per share. This describes the private placement to their sponsor. More units were sold at the same $10 price. These units have some restrictions on when the sponsor can sell them, typically tied to the company's stock performance or a lockup period after a business combination. This section is usually where things get interesting. They discuss founder shares, which are shares given to the sponsor for a very nominal amount, typically in exchange for their early support and covering initial costs. Here we see that on the 10th of June 2025, the sponsor paid $25,000 for about 2.875 million Class B ordinary shares. These founder shares have conditions, including some being subject to forfeiture if the underwriters did not fully exercise their option to buy more shares. Good news for the sponsor, that over-allotment option was fully exercised on the 9th of October 2025. So those shares are safe. There is also an agreement to pay the sponsor $10,000 a month for office space and administrative services, starting in October 2025. This is a common arrangement to ensure the company has the basic infrastructure it needs. Interestingly, they had a promissory note from the sponsor that could be for up to $300,000, but it was non-interest bearing and was to be repaid by the 31st of December 2025, or upon the IPO closing. Thankfully, for the company, the IPO closed, so this note is no longer a concern for repayment from operating funds. We see that the sponsor also paid certain costs for the company, and as of the 30th of June 2025, the company owed them over $131,000. This is a common way to fund early operations. This note covers the agreements and potential future claims. Holders of founder shares and private placement units have registration rights. This means the company is obligated to help them sell their shares in the future by registering them with the SEC. This is standard stuff for these types of deals. This details the deal with the underwriters of the IPO. They got a cash fee and a deferred fee that only gets paid if the company successfully completes a business combination. This aligns the underwriters' incentives with the company's success. This section breaks down the ownership structure. It explains the different classes of shares and the number of shares authorized and outstanding. For Class A ordinary shares, there was 0 outstanding as of the 30th of June 2025. But as a result of the IPO and private placement, over 360,000 Class A shares were issued. The Class B shares, the founder shares, are mentioned again with their total outstanding number. It is important to note here that before they find a business to merge with, only the holders of Class B shares get to vote on electing directors. The Class A shareholders don't have that power yet. This gives the founding team more control in the search phase. This tells us about their operating segments. For AA Mission Acquisition Corp. Thucken, there is only one operating segment and the Chief Executive Officer is the person making the key decisions. This simplifies things as the entire company is viewed as one unit. This is where they update us on what happened right after the reporting period. This note reiterates the IPO closing on the 2nd of October 2025 and the private placement details. Crucially, on the 9th of October 2025, the underwriters fully exercised their option to buy an additional 1.5 million units. This means more money for the company and more shares issued to the public. Now let's look at management's own explanation of their financials. They are very upfront about being a blank check company and that they have not yet identified a merger target. They state clearly that they have not generated any revenue yet and all activity has been organizational. They expect increased expenses after the IPO due to being a public company. The net loss of $42,593 for the period is attributed to general and administrative expenses as already seen in the financials. This section talks about how they have enough money to operate. After the IPO and the over-allotment, they had over $1 million in their operating account. They estimate their primary liquidity needs for finding a target, legal fees, reporting, and other overhead totaling around $810,000. They believe they have enough funds for this period and don't expect to need more capital, unless their expense estimates are off or they need to redeem a lot of shares. This repeats the earlier point about substantial doubt regarding their ability to continue as a going concern if they fail to complete a business combination. It is a standard warning for SPACs. This repeats information from the notes about founder shares, private placements, administrative services, and the due to related party balance. It emphasizes the sponsor's role in funding and supporting the company. As a smaller reporting company, they are not required to provide detailed market risk disclosures. This means information about how their financials might be affected by things like interest rate changes or currency fluctuations is not provided in this report. This is an important section about how the company manages its information and financial reporting. They admitted that their disclosure controls and procedures were not effective as of the 30th of June 2025. This means that the systems in place to ensure that all important information gets recorded, processed, and reported accurately and on time were not working as well as they should be. They are exempt from providing a full management report on internal controls over financial reporting for now, which is common for companies in their first year as public entities. Since the last report, there haven't been any material changes to their internal controls over financial reporting. This suggests they haven't made significant fixes to the issues identified in their disclosure controls. This lists all the supporting documents filed with the report, including certifications from the CEO and CFO. So, what is the big story here? This is a company in its infancy, focused entirely on finding a business to merge with. The financials for this very early period are quite minimal, showing the costs of getting set up and preparing for an IPO with no revenue yet. The key takeaway is their reliance on the sponsor for early funding, and the fact that most of the IPO money is locked away in a trust account. They've been honest about the lack of effective disclosure controls, which is a red flag, but they are a new company still building its internal processes. The biggest risk, as always with SPACs, is failing to find and complete a business combination within their timeframe. This would lead to liquidation. The good news is they've secured significant funding through their IPO and the sponsor's support, and the over-allotment being fully exercised bodes well for their ability to attract investors. Overall, AA Mission Acquisition Corp. TRU is in the crucial early stages of its life as a public company. Its success hinges entirely on its ability to find and execute a valuable business combination. The financial statements reflect this early stage, with minimal activity and costs associated with becoming public. Keep an eye on their filings to see if they can find that right partner. Alright, that is our breakdown of AA Mission Acquisition Corp. The fix: latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.